Morning, everybody. I see everybody starting to come in. We have a lot of content today, so I'm going to go ahead and just get started with the introductions while everybody's kind of coming into the webinar. As I said, good morning. Welcome to Maner Costerisan's Nonprofit Education Series. Today, we're going to be doing 9 topics in 90 minutes. So we have 9 great speakers, and we're going to be talking about little tidbits of information that hopefully is helpful for you. A few housekeeping items. The session is being recorded, and everybody will be muted. If you do have questions, please put them in the chat function and we can get to those at the end of the session. I'm going to have Sydney talk real quick about the CPE portion of this webinar so that everybody's aware of those requirements.
Yes, welcome everyone. Quick note, so we are offering 1.8 CPE credits for this webinar. You will see periodic polls pop up on the screen, so please select the circle for the answer and click submit. Given our 90-minute time frame, we'll have at least 5 CPE polls. So to qualify for any CPE, you will need to participate in at least 3 of the attendance polls and attend the webinar for at least 50 minutes. CPE above 1 credit will be prorated based on the number of polls answered and time attended. So for full credit, you would need to attend for 90 minutes and answer at least 4 of the polls. And then based on the requirements that you meet, we will send CPE certificates to the email that you registered with via our learning management system, Prolera, in the next week or so. So Brandy, I am going to go ahead and turn it back over to you.
Okay, thank you. So I'm going to be presenting first. I'm going to share my screen here. Hopefully everybody can see that. So today I'm going to talk a little bit about what's new with the IRS. I mean, not a lot, but we'll go through what we do have. So every year the IRS does come out with a priority plan, and it affects all types of returns, but today we're going to focus on the exempt org area. We're going to talk a little bit about some IRS communication, some e-file news, and then some education that the IRS has available. So the IRS priority plan breaks it down into 5 different areas. So today we're going to talk about the things in these areas of better taxpayer experience, faster issue resolution, which we all want, smarter enforcement, advanced technology and analytics, and empowered employees. So when the IRS is talking about better taxpayer experience, what they're really looking to do in this area is to improve those services to help taxpayers meet their obligations and receive the tax incentives and things that they are eligible for. And a lot of this is about reaching all taxpayers, even those that are in underserved areas or underserved taxpayers. So they're going to focus on connecting with the public better and to serve those underserved taxpayers. They're also going to continue to promote the use of the digital communication vehicles. They're going to, try to make it more available for people to use online services and things like that. They're going to provide education and outreach to help tax-exempt entities make complete and elective payments for the new clean energy credits under the Inflation Reduction Act. And one of the other priorities they have is that there's going to be a Native American initiative focusing on increasing access to tax services throughout the Indian country. This is an important one, faster issue resolution. We all know how difficult it is sometimes to get through to the IRS. We spend a lot of time in our practice on the phone, getting dropped from calls, writing letters, all of the things. So this is something that's always a priority for the IRS. And so they really want to quickly resolve taxpayer issues. Now, we all have a different definition of quickly, but their quickly, and our quickly is a little different. But they're going to look at supporting effective processing and compliance for those clean energy credits that I just spoke about. They're going to support efforts to review and address ERC credit claims. We do know that there's a lot of ERC credit claims that are still outstanding. And so one of their priorities is to address those. Collaborate across the IRS to streamline notice processing. So as many people know, normally we are responding to notices either by a call or by a letter. Calling the IRS can be a little bit of a struggle, and letters can take months and months to resolve. So they're looking at a 2-way kind of electronic communication between taxpayers and the IRS regarding these types of notices. So it may be like an online portal or something to that area. And then also continue efforts to improve filing and reporting clients with that exempt sector. Smarter enforcement. So for audits, I will be honest, and I was telling someone today, in my career of doing nonprofits, I've had 2 IRS audits. So it goes to show there's not too many IRS agents out there, auditing our client base, which is great, but knock on wood, there's always been some talk about the IRS getting more and more auditors. And so we want to make sure that we're ready and we look at those types of things. So they're going to focus on expanding their enforcement on taxpayers with tax filings, especially in those high dollar non-compliance areas to address that tax gap. They're going to use data, they're going to use analytics to try to refine how they select organizations in order to pick the right ones, so they're getting like more bang for their buck, I guess, when they're picking those audits. Some of the common audit triggers that we see are Form 990 indicators. So this could be something that isn't accurate on the return, or something that is like governance questions that maybe that we ask, if they have a conflict of interest policy or those types of things. They say that those don't trigger audits, but we want to make sure that we have a complete and accurate 990. Referrals, the IRS does have a robust referral system, and that's for kind of like a whistleblower. If you think an organization is not doing what they should be doing, you can refer them to the IRS, so they will pick up audits from that. Organizations that have foreign activities, that seems to be a bigger thing now, because they want to focus on money that's getting sent to another country and make sure that it's actually being used for charitable purposes and not being diverted away from that. Accurate reporting of fundraising, income, and expenses. That seems to be an area that they're starting to look at. But we all know fundraising and gaming can have some issues there. And so making sure that that's being reported correctly. Compensation. Not only does the IRS look at high paid executives when it comes in regards to like their total expenses, but they also look at low paying executives to make sure that there's not underreporting happening, or that they're not reporting all of their compensation. And then, as we all know, UBI is an area that gets audited due to the fact that they can actually make revenue off of that area. The IRS is going to be starting to use more data, more online sources, more AI in order to prioritize their audits and things like that, like I had mentioned earlier. And just like any other business, the IRS really wants to make sure they have good employees. So they're gonna take time to put some effort into, having new hire feedback, career training, and building that team culture. Because we all know that good employees are going to, provide good customer service. So they're also going to focus in the same areas that we do when it comes to empowered employees. I won't go through all of these, but these are some of the technical things that are coming out of the priority plan. There's some guidance on group exemption letters, the final regs on supporting organizations, the regs that came out a while ago. It's been years, and now they're finally making them final. There's some things on expenses when computing UBI, and then also how the new NOL rules affects that. There's some things on donor advised funds. Those are becoming more popular. And so there's quite a few things that they came out with in some of the regs that I've listed there today. The IRS has a few different things that we use pretty regularly to be able to look up information on our nonprofits. But the first one I had mentioned earlier about the referral complaint process. So they do have a place on their website where you can, if you feel there's an organization that isn't doing the right thing, that you can refer to this website. We also use IRS Select Check. It's something I immediately go to anytime I get a new client, just to make sure they're up to date on their filings, they're up to date on they haven't been revoked or anything like that. It's a great way to look up organizations. You can also look up if you're granting an organization, you want to make sure what type of organization they are. You can also go there and look. The IRS does have a master file also, that it's not updated regularly, but it is updated a few times a year. And that's really a master file of all organizations. So that's really nice to be able to look up. And then the TEGE Council is an external council, but it comes together to correlate with the IRS and the practitioners to be able to find common ground and have some trainings associated with that. E-file news. So as everybody knows, e-file is mandatory for 990s. We also have 1023 and 1024 applications are all done now on pay.gov. Pay.gov does have a new ID Me login. So if you haven't logged in a while, you may have that this next time that you log in. Form 8940, which is a request for miscellaneous determination or a change in type of a structure of nonprofit that you are, is now also available on pay.gov. And then I made a note about EFTPS. So look for an online version of most anything that you're doing now, because they're really going to start trying to go that direction. And here, I'll be quick, just some webinars, workshops, and things that the IRS has that's available to you if you want to learn about any type of things that they might have listed. Definitely go to stayexempt.irs.gov. It's a great place for nonprofits to go and get some education from the IRS. And with that, I'm going to change it over to Kimberly Westfall, who's going to talk about best practices for functional expense allocations.
Thank you, Brandy. Yes, I'm Kimberly Westfall, and I am a senior manager here at Maner, specializing in audits of nonprofit organizations. And I'm happy to be with you this morning to talk a little bit about best practices for functional expense allocations. So let's begin with some foundational information to make sure we understand the terminology and requirements related to functional expenses. As you're likely aware, expenses can be reported based on their natural classification, and these would be things like salaries and benefits, utilities, depreciation, etc. But they're also presented functionally, meaning they're broken out by major classes of program and supporting services. And this is required by accounting standards to help users of financial statements to assess the organization's service efforts, including the cost of its services and how it's using its resources. So what are program and supporting services? Program services are those activities that result in goods and services being delivered to your beneficiaries, customers, members, etc., that fulfill the purpose of the nonprofit organization. Supporting services are all the other activities that are not program services, and those can include management in general, which can include things like accounting and budgeting, finance, human resources, etc. Fundraising, which can include maintaining donor lists and conducting special fundraising events, and membership development, which could encompass things like soliciting membership dues and member relations. So organizations need to determine whether costs relate directly to a particular function or program, or they relate to multiple functions and need to be allocated to more than one area. And they also have to consider whether the costs relate to the direct conduct or direct supervision of activities. So one example that's given in the accounting standards is there's a CEO. And if that CEO spends a portion of his or her time directly overseeing a research program, that portion of their compensation and benefits should be allocated or charged to that program. However, the portion of the CEO's time that is spent indirectly supervising the overall operations of the nonprofit would be considered management in general costs. So first, the nonprofit needs to identify those costs that are related to the direct conduct and the supervision of programs, and then those that are indirect. The direct costs, they're going to be charged to the programs, and then those that are allocated based on some sort of reasonable method. And that's the responsibility of the nonprofit to select that method. So in determining the basis for allocating the costs, the organization needs to consider what drives the cost. So for instance, personnel costs are often driven by time and effort, whereas we'll see that building costs or occupancy are often driven by size and square footage. So once you've determined the appropriate or reasonable basis for allocating your costs, then it's time to actually calculate those amounts and perform that allocation. So the standards have certain presentation requirements, and what they specify is that there must be an analysis of expenses by nature and function, and it needs to be presented in one location. And there are a few different options of where that can be presented. It can be on the face of the statement, can be as a separate statement, or as a schedule in the notes to the financial statements. And what we often see our clients doing is including a statement of functional expenses. The notes to the financial statements must also disclose the methods or the basis used for allocating expenses between program and support activities. And we'll talk about this a little more in a moment. So here's an example of a statement of functional expenses that's provided by the AICPA. The rows represent the natural classification of expenses. So again, that would be things like salaries, legal fees, occupancy costs, depreciation, etc. And then the columns represent the program services and supporting services. We also have here an example of an accounting policy disclosure related to the functional allocation of expenses. You'll notice here in the middle of the footnote, it specifies the types of costs that are being allocated, and then it details how those are being allocated. So it mentions the employee benefits are allocated based on salary and wage analysis, whereas the other costs are allocated based upon square footage. So now we've reviewed some of the requirements and definitions, so let's talk about some errors to avoid or things to watch out for. It's important to remember that information within the financial statements or footnotes should be consistent with corresponding information presented elsewhere within the financial statements. For instance, functional categories reported within the statement of activities correspond with those reported on the statement of functional expenses. Likewise, the total of the columns on the statement of functional expenses should tie to the corresponding expense lines in the statement of activities. So let's take a look at an example of what I'm referring to. The inset box here is an excerpt from this example's statement of activities. So as an illustration of what I just mentioned, you'll notice that the lines within the program services section tie to the columns used on the statement of functional expenses. Likewise, you'll notice that the expenses reported on the rows in the statement of activities tie to the totals of the various columns in the statement of functional expenses. Another area to watch out for is improper natural expense classifications. For instance, we shouldn't have a line called human resources. Human resources would actually be made up of various costs, including salaries, benefits, maybe legal, etc. And those descriptions would be the natural classifications rather than human resources. Failing to allocate expenses is another thing to avoid. For instance, we need to make sure that we don't leave all of the depreciation expense or occupancy expenses in management in general. Those should be allocated to the various programs. Speaking of fundraising, if your organization incurs, fundraising, if your organization incurs expenses related to running fundraising campaigns or soliciting donations, those need to be appropriately reflected. Even if some of your costs for fundraising get allocated to a program for one reason or another, there would still likely be some costs that would remain within the fundraising function. It's also important to find the right balance between too much detail and too little. You'll sometimes find that if the statement of functional expenses reports too many programs or natural expense categories, it can lead to information overload, making it hard for your reader to digest the information. So try to identify some natural expense categories that could potentially be combined into a single line. So let's say you have legal expenses and accounting and auditing costs. You might be able to combine those into a single line called professional fees and services. Likewise, your organization might operate a variety of programs, but you may find that there are a few overarching categories that you can combine and then have less columns on your statement of functional expenses, making it easier for your reader. All right, so you may be thinking, I already allocate my expenses. I'm good. Now what? Well, it's important to make sure that you've documented your allocation policies and methods, and then that you apply those consistently year over year, assuming everything else is equal. Now, having said that, let's say you have a capital project going on, and that's going to have an impact on your square footage. Remember, this is a great time to then assess your methods and review your practices and adjust accordingly. And keep in mind that when you're making adjustments to your allocation policies or methods, that you discuss those with your auditor and ensure that they're properly disclosed in your financial statements. I hope that these suggestions related to functional expense allocations have been helpful to you, and I will turn over the time to Courtney Bean, who is going to be sharing an update on CECL.
Thanks, Kimberly. Let me just quickly share this. All right, so I'm going to talk to you about CECL, which is the current expected credit losses standard. It's new this year. So quick overview and background, we're doing implementation, an example, and then a summary and conclusion. So what is CECL? It is an accounting standard introduced by FASB that changes how organizations account for credit losses on financial assets, such as loans, debt securities, and trade receivables. It replaces the previous accounting standard, which was based on the incurred loss model, which is supposed to be a more forward-looking approach with this new model. So under CECL, organizations are required to estimate and recognize the expected credit losses on their assets over the contractual life by considering historical experience, current conditions, and reasonable and supportable forecasts for the future. The shift in the approach is aiming at providing a more accurate reflection of the credit risk associated with these assets and promotes early recognition of potential losses in the financial statements. So it does not apply to promises to give and most grants receivable if you're following the contribution model. So if your organization is primarily contribution-based, this standard may not apply. It has an effective date for organizations with fiscal years that begin after December 15th of 2022. So basically December 31st year ends of this year. And it is a modified retrospective approach, which means you will have a prior period adjustment to the opening balance of net assets. So quick background on why we're here and why we need this new standard. So there's really three main categories or reasonings of why we are implementing a new standard. So the first is the timing of loss recognition. Under the incurred loss model, credit losses were only recognized when they are either probable or had actually happened. So CECL requires recognition of credit losses over the entire life of the asset, even before they are going to happen. So you may issue a note receivable to a client, and under the incurred loss model, you may not record a allowance until year 2, year 3, whatever. Under CECL, you might have an allowance on the day 1 of that asset. The next item is use of historical information versus forward. So incurred loss model relied heavily on historical data. You couldn't really account for current conditions or future projections, which is what CECL has aimed at correcting. And then a change in the loss horizon. So the incurred loss model typically looked 12 to 18 months out from where you are, where CECL looks at the entire lifetime of the asset. So what does this apply to? It's really any financial asset that's not measured at fair value. This includes loans, financial receivables, and receivables under Topic 606. So if you do have membership dues receivable, this technically would qualify. And what is excluded? So like I mentioned previously, contributions, promises to give, and most grants receivable are excluded. They're all from donors, and you're not issuing credit to them, so there is no credit loss exposure here. And then financial assets measured at fair value through the change in net assets. So these two items are what you primarily will see in a nonprofit organization, but there are two more at the bottom there. Well, let's talk about implementation. So there are three main categories here that we'll talk about. And then there's the fourth one that is kind of like an off to the side that you don't really want to use that much. So the first one is historical loss information. You probably already have this information. This would be, your allowance for bad debt on like a notes receivable. So say you have a 30-day plus category on your aging schedule with an allowance of 10%. You already have that information. Next, you're going to look at current conditions. So you could factor in unemployment, for instance. Maybe unemployment has gotten better, more people have jobs, they're more able to pay their bills, which means you're probably going to see some of those payments come in. With this, you could say, we're at 10%, but maybe we should actually reduce it because we're more likely to get paid. So let's reduce it down to 5%. The third item, you're looking to forecast into the future. So a forecast needs to be reasonable and supportable. So make sure you have adequate documentation that you can support your calculations. So you're going to look into the future a couple years and you think maybe in the future it's still going good, but maybe not as good as the current conditions, maybe not as bad as historically. So somewhere in the middle. So we went from 10% to 5%, but really let's go up to 7% as like a happy medium for the future. And that's how you come up with your expected credit loss. And I did mention the reversion to history is kind of like this little sidebar option, like a backdoor. It's not meant to be used as a backdoor or like a cheat code, It's really only if you cannot adequately forecast. You can't just say, I want to take the easy way out and take the reversion to history and use the historical data information. If you do use reversion to history, you have to make sure it's well documented and that you can support it and why you cannot use forecast. So real brief here, information to consider. There's no mandated approach. Every organization is different. So this will vary greatly from one to the other. If you have recoveries, you need to include them when you're estimating your allowance, and the amounts written off cannot exceed amounts previously written off. And then when you are evaluating your assets, like assets need to be pooled together. So all notes receivable of similar characteristics, same with AR. Assets that are not similar to others can be evaluated individually, but you cannot have assets in both categories. And once a year at minimum, you do need to evaluate these categories and make sure they still make sense. So here are some options for pooling your assets. You could say all notes receivable located in Lansing, Michigan that are due in the next 5 years. This will give you asset type, term, and location. So you can select as many or as few of these as you need. And I'm not going to cover this, but it is here for your reference in the future, as well as some financial statement information. Do you want to get to our example? So we have a university that has a Perkins Loans program where they offer loans to students. Loans are very similar. They're typically 10 years with similar interest rates. And so because of how similar they are, we are going to pull all of these loans into one category. The university has the historical information with the aging and the loss percentages, and they've come up with this schedule. Looking into the current conditions and the future for their forecast, they have determined that economic conditions have improved, and they actually should decrease their loss ratings by about 10%. And I say about because the prior slide was rounded where these ones are a little bit off, but as you can see, these are roughly 10% on the credit loss rates lower than the prior slide. So they take their total loans under the amortized cost multiplied by the rate, and they come up with their new expected credit loss estimate. And this is the amount they would record on the statement of financial position and reflect as a credit loss expense or recovery. So it was really brief, it was really quick. There's a lot to cover, but basically it is here. If you have a December year end, it is here. You need to base your loss on historical experience, current conditions, and future forecasts, and you need to make sure you have data to support that. There will be a prior period adjustment to the opening net asset balance for the period you adopt it. So what should you be doing now between now and the next month and a half for the end of the year? I would say determine how you're going to calculate this. What are you going to use? Are you going to look at unemployment? Are you going to look at something else? Make sure your historical data is accurate and readily available. And then think about anything else you need to include. If you are changing your policies, your procedures, any internal controls, make sure you're doing that and you are updating them and having them readily available for your auditors. And that is pretty much all I have. I know that was really brief, so feel free to contact me in the future if you have questions. I am going to turn it over to Amber, and she's going to talk about how organizations lose their tax-exempt status without trying.
Thanks, Courtney. Let me just share my screen here. Oops, bear with me. Okay, hopefully everyone can see that, me and the slide. And so I'm Amber Rathbun. I am a senior manager. I work primarily with our nonprofit clients in the tax area. And as Courtney mentioned, I'll be talking today about how organizations lose their tax exempt status without even trying to. And it does look like a CPE poll has popped up, so be sure that you answer that. All right, so for today's agenda, I'm going to talk a little bit about why it matters. Why is it a big deal if an organization loses their tax exempt status? I'll touch on automatic revocations, and then I'll talk about other ways that organizations jeopardize their tax exempt status. And then I will touch briefly on reinstatement, resources, and my contact info will be at the end of the slides if there are questions. So why does it matter? One of the most obvious reasons this matters is if an organization loses their tax exempt status, that means they're no longer exempt from federal income tax. So if an organization were to lose their status and then not apply for reinstatement or have open years where they weren't tax exempt, technically those years there was a for-profit, taxable entity filing requirement, such as Form 1120 or Form 1041. This is a big deal for donors because if they're making large contributions, they're possibly looking to get a tax deduction for those contributions they're making to the organization. And so when a tax-exempt organization is revoked, the IRS does remove or modify them from different publications, either removing or indicating that the organization is no longer tax exempt. So donors are not able to make tax deductible contributions once an organization is revoked. There are some state implications to think about. So if an organization is not in compliance with the IRS, then, for example, if they're a Michigan organization, they also are not in compliance with the AG office. So if a donor were to try to look them up on the website or call the AG's office, they would find that the organization is no longer tax exempt and not in compliance. There's also some real property and sales tax exemptions to think about. And then I did want to say, reinstating tax exempt status. So this is another reason this is a big deal is because it is very timely and costly to get an organization's status reinstated. You do have to go through the whole process again of applying for tax exempt status, and the IRS does not provide an appeal process and doesn't undo those revocations unless they were in error. So anyone who's been through that application process will know how much time is involved, and it does take the IRS quite a bit of time to approve those applications. So automatic revocation happens if an organization fails to file their tax returns for 3 years in a row. This is a pretty timely presentation because yesterday was the big deadline for calendar year organizations who were on extension. So yesterday was a deadline for organizations that don't file for 3 years. Again, the IRS will automatically revoke their tax exempt status. And one thing to note is that while an organization is waiting for approval for an application they submitted, they are required to file tax returns during that time. Another thing to note is that the IRS does consider the time that the organization applies for an EIN. That really starts the clock of when that organization is established and when they start having filing requirements. When an organization is automatically revoked, the IRS does list the organization. And even if an organization is later reinstated, that organization stays on that list. So just know that that's out there for the public to know that your organization was revoked and maybe later reinstated. And then again, donors can deduct their donations that they make up into that revocation date or the date they're on the list. So other than automatic revocation, which is a really easy way to lose your status, just not filing tax returns, there are some other ways that organizations can jeopardize their status. Really, what we want to think about here is the organization operating primarily for their mission, for the reason that they're tax exempt? Once you start having substantial lobbying activities or unrelated trade or businesses, that's really takes over the primary purpose of the organization, then that's when that becomes a problem. Definitely, we don't advise clients, to not do any unrelated business or not have any unrelated business income or not do any sort of lobbying, but just know that those are restricted and they shouldn't become a substantial part of the organization. There is a 501H election available to organizations so that they can have more of a bright line test in terms of lobbying for what is substantial for their organization. So that's something that C3s can consider. And this slide is specifically for public charities. So there's some other items mentioned here. Obviously, if activities are illegal, we don't want to be doing that. That shouldn't be any part of the organization, even insubstantial. So this next slide is specifically for private foundations. It is very similar to the previous slide, but what I do want to mention is that there are some activities that public charities can do, but just know that it could result in excise taxes for private foundations. So thinking about lobbying activity, transactions that benefit an individual, which I did want to mention for public charities, if there are business transactions with insiders, so board members, family members related to board members, substantial contributors, organizations really want to make sure they're doing their due diligence and that those board members aren't voting on those matters, that the organization is getting bids, making sure that they're just doing their due diligence there, because the purpose of the organization should not be to just benefit an individual. Really, the purpose of the organization is their mission and benefiting the public or a portion of the public. So other ways to lose status, or for example, public charities generally want to avoid becoming private foundations. And I know Anna is going to talk later in the presentation about public support test. Organizations want to make sure that they are passing the public support test and definitely not failing that test 2 consecutive years. You don't necessarily lose your tax exempt status, but you could switch from a public charity to a private foundation. Then I did want to note that the IRS sent out 30,000 erroneous auto revocations for the fiscal year ending September 30th, 2022. And that was because they were simply slow to process the returns. So they were kicking out these auto revocations that were in error. And I do have noted on the slide, not sure if you can see it very well, but the fax number is 855-247-6123. And that is a fax number dedicated specifically to resolving those automatic revocations that were in error. So if an organization can prove they were filing their returns, they can, fix that issue specifically with that number. So touching on reinstatement and resources, there's a few methods for reinstatement. Mainly, there's retroactive reinstatement, and then there's the postmark date reinstatement. Working with your trusted advisors, CPAs, attorneys, they can definitely assist with the reinstatement process if your organization is in a revoked state. They can also, they're there to help with compliance matters. If you have questions, if your organization is jeopardizing their tax exempt status, they're definitely there to assist to make sure your organization is doing what they should be doing. And then just some resources mentioned here. The IRS website does have a lot of resources available, including CPE articles, mini courses, compliance guides. So any questions? My contact info is on the screen. I am going to stop sharing, and Renee is next to talk about budget setting.
Thanks, Amber. So good morning, everyone. I'm Renee. I'm a manager in the Accounting and Outsourced Solutions Department, and I primarily work with nonprofit organizations. Today, I'm going to dive into the world of nonprofit budgeting, exploring the best practices for constructing annual and grant budgets, as financial stability is crucial for the success of any nonprofit organization. The budgeting process serves as a backbone, providing a roadmap for achieving goals, managing resources effectively, and securing grants. So understanding the importance of budgeting. Up first is financial planning. Budgets help in planning and managing financial resources, ensuring the nonprofit remains sustainable and impactful. Transparency and accountability. Transparent budgets are vital in gaining trust from donors, shareholders, and the public, showcasing how funds are allocated and utilized. And then grant acquisition. Well-structured budgets increase the chance of successfully acquiring grants by demonstrating a clear plan for their utilization. So crafting the annual budget, first we have to start with our evaluation and assessment. Start by reviewing past financial records and program outcomes to set realistic financial goals and objectives for the upcoming year. Review grant agreements and understand any restrictions to expenses there may be. And another great place to start is looking at current year's financials and budget versus actual. Review which accounts are over or under budget. If you have a reasonable explanation, or was it just out of your organization's control, kind of going through those items. Up next, engage your shareholders. So involve various stakeholders, including board members, staff, beneficiaries, in the budgeting process to gather diverse perspectives. Make sure to include those who work closely with related funds you are budgeting. Often those employees who are running the grant programs are the most knowledgeable on the grant requirements. And then allocating resources. So prioritize programs and allocate resources efficiently based on their impact and alignment with the organization's mission. Understand the allocation stipulations that may be in place for each grant, and if there happens to be an admin cap. So some key components of an annual budget. Income projections, detailed source of income, including donations, grants, fundraisers, and any other revenue streams. Take a look at current year revenue, consider if there are any new sources or if any will be eliminated. Expense breakdown. So outline detailed program costs, administrative expenses, and fundraising expenses. Make sure you understand if there is an admin cap and what percentage that is. That information is often found in the grant agreement. Staff planning. Is the organization growing? Will there be new positions next year? What raises can the budget sustain? And what about bonus or other benefits to staff? It's important to take all those into consideration. I know this area is often the largest piece because if you have many employees, it can take a lot of time to go through all that. And then contingency planning. So set aside reserves for unforeseen expenses and emergencies to ensure financial resilience. Often an organization will utilize any fundraising income for this, or I see a lot of organizations using COVID-related money like the employee retention credit they received for this as well. So some tips for grant budgeting. Make sure you understand grant guidelines. Thoroughly review grant guidelines to align the proposed budget with the donor's objectives and expectations. Make sure you understand if there are any thresholds for admin costs versus program costs or anything disallowed. Frequently, I see a 20% admin cap, and some common disallowed expenses are lobbying or meal. I've even had one grantor want to ask a client to remove a bag of candy they purchased for the office for their employees, so they can be extremely picky. Details and clarity clearly outline how the grant funds will be used, providing specific line items and justification for each expense. If you have multiple grants, a great place to start, if you don't have this set up already, is making a list in Excel of the grant details of the grantor, dollar amount, grant period, and any stipulations there may be. This can help organize what you need to put into the budget, and a great place to reference all the details in the future. So realistic and feasible, craft a realistic budget that aligns with the grant scope and the organization's capacity to execute. Oh, there is a CPE poll, so go ahead and answer that. At the end of the day, it is a budget. I know that it can and likely will change throughout the year. So strategies for successful budget implementation, monitor and review. Regularly monitor the budget to track spending and make adjustments when necessary, ensuring financial health and adherence to plans. Make sure you're running a budget versus actual every month and a grant versus budget as well. These are your key tools to ensure that your organization is on track with grant expectations. Adaptability, be flexible and adaptable to changing circumstances, adjusting the budget when needed while maintaining the organization's mission. Did your organization receive a new grant? Is the grant period changing, or perhaps a grant is on hold for the time being while programming is being organized? These are all triggers to go back and review your budget. And then communication and reporting. Communicate budget progress and achievements to stakeholders, donors, and the community, showcasing the impact achieved with allocated resources. Go through the budget versus actual and the grant versus actual with your board. If your board doesn't want all of that detail, perhaps provide a cover sheet highlighting the key accounts over or under budget. And some tools and resources. So budgeting software. Utilize specialized nonprofit budgeting software for accurate financial tracking and reporting. It could be as simple as QuickBooks online or as detailed as a budget module in Sage Intacct. Use some professional assistance. Consider seeking assistance from financial experts or consultants specialized in this area. And then training and education. Invest in training for staff and board members to enhance the understanding of financial management and budgeting principles. Often grantors have introductory meetings when the monies are first awarded to go over the details and the expectations. Having staff attend those meetings can be incredibly beneficial. And then some challenges and solutions. So unpredictability of funding. Nonprofits often encounter fluctuations in funding due to changing donor priorities, economic conditions, or unexpected events. I have one nonprofit that I work with that receives only one federal grant, and that is all the funding they receive. Without that, their organization would not exist. So a solution, diversify revenue streams, reduce reliance on a single funding source by diversifying income channels. This could involve exploring individual donors, corporate sponsorships, partnerships, or revenue generating programs that align with the organization's mission. Next is limited resources. Nonprofits often operate with constrained resources in staffing, monetary, or other resources, leading to difficulties in fulfilling all program needs and organizational requirements. So some solutions, strategic partnerships, collaborate with other nonprofits, business, or government agencies to share resources, expertise, or infrastructure. Pooling resources can help reduce costs and expand your impact. You would be surprised at how many nonprofits are willing to help each other out, whether it's joining efforts on a fundraising event, sharing office space, or staff sharing, for few examples that I have seen. And administrative burden. The process of budgeting can be time-consuming and complex, particularly for smaller nonprofits with limited administrative capacity. I find a lot of organizations aren't sure where to start or are overwhelmed by the thought of putting a budget together or the stress of being completely off with the budgeted numbers versus actual. So solution, technology integration, implement budgeting tools and software specifically designed for nonprofits to streamline the budgeting process, enhance accuracy, and reduce administrative burdens. Adapting to changes. So nonprofits must remain adaptable to changing circumstances, requiring flexibility in the budgeting process. This could be annually or even as frequently as monthly. A lot of nonprofits I work with are always applying for new grants. To overall organization budget is changing to adapt to the awarded funds. So a solution is scenario planning, develop alternative scenarios and contingency plans that can be activated in response to unexpected changes, and regularly revisiting and updating the budget based on evolving circumstances help in maintaining flexibility. Then last, lack of expertise. Limited financial expertise within the organization can hinder effective budgeting. A solution, training and consultation. Invest in training for staff and board members to enhance their financial management skills. Additionally, consider seeking guidance from financial experts or consultants specialized in nonprofit budgeting to provide valuable insights and guidance. So that wraps up my presentation. And up next is Kyle with crypto and ESG reporting.
Okay. All right. Good morning, everybody. So today, I'll cover a little bit about what's new in nonprofits. Trying to keep it in 10 minutes or so get you through to the top of the hour. Not quite a technical update this time, but we do have a high level for a few minutes for a couple things to hit on. So as far as trying to come up with topics for today, we participate with probably many people on the call, attending the ASCPA's annual conference for nonprofit organizations. And so looking through, I think this was back in June, some of the top priorities, for invitation to comment. Hopefully you can see all right. The two items for today would be digital assets. So oftentimes that'll include cryptocurrency or crypto assets. And also the second item was ESG, environment, social, and governance related transactions or disclosures. So as far as today went, Kimberly hit on some of the existing standards. Courtney hit on something that's new for 2023. As far as digital assets and ESG related items, this is really just kind of a kickoff, if you will. As of today, there's no set effective dates for these topics, but just making sure that you're aware of, and that way, as more information comes to light or as standards come out, we can share more as they come around. So as far as the two that I mentioned, crypto assets and ESG, I'll start with crypto assets. They're a little bit further along as far as standards go. And so I'll hit on some of the current issues, a little bit from the FASB's exposure draft that was issued in May. I think the comment period ended in June, updated in September. And then a little bit as far as what's next from a crypto asset standpoint. On the ESG side of things, cover some of the core areas as it relates to ESG, some opportunities for nonprofits, and what's next or what's ahead. So as far as those on the call, what we typically see from a crypto asset or cryptocurrency is right now generally in the form of contributions, often a Bitcoin or Ethereum or similar asset that comes in, and for the most part, donors are trying to save some taxes, and the organizations follow their gift acceptance policy, so typically convert right into cash, and potentially, if it's to be invested, in alignment with their investment policy. And so that's usually pretty straightforward, but what we'll hit on today is what's more for when you maintain crypto or digital assets and what that looks like for your organization or challenges. So as far as some current issues with crypto assets, the accounting doesn't reflect the current economic value. So current accounting, you don't recognize any gains, realized or unrealized. So the value doesn't go up, if you will, kind of at cost. And then if you do have any changes, it would be through an impairment, and those do not reverse as of today. Also, challenges would be trying to make sure you can locate and actively traded markets. Impairment would be another issue. It's typically hard to determine and costly to apply. There are a lot of different exchanges for digital assets, so not always having an easily observable value. And it's not, kind of a stable item for many assets, so the assessment may need to be occurring more frequently throughout your reporting period. The other area that's been a challenge is inconsistent application. When there's not a lot of authoritative guidance, interpretations may differ across organizations. There is an AICPA guide available, but it's non-authoritative, so best to follow until more authoritative guidance is available. Other challenges that I mentioned would be valuation. A lot of times there's not a central exchange, and the exchanges do operate on a 24/7 basis. So trying to find that principal market for valuation. As far as kind of going into that exposure draft, hoping to have from the presentation disclosure standpoint more alignment for organizations. So things that would be useful for financial statement users would be what types of crypto assets, unit quantities, the cost, as well as the fair value. And then some also supplemental disclosures from a GAAP standpoint. So moving on to, what did the FASB do this year as far as an exposure draft? I mentioned that came out in March. Exposure period was through June. Trying to have alignment from accounting for crypto assets, defining what's included or excluded. And so for the most part, you'd have presented as an intangible asset, but separate from the other intangible assets of the organization. So improved accounting guidance from that standpoint. Also more decision making useful, moving to the fair value measurement away from the cost or impairment model that I'd mentioned. From a presentation item standpoint, like I mentioned, some of the activities are just conversions from the digital asset to cash, but making sure they're consistent reporting in your statement of cash flows and being presented separately from the other intangible assets, like I mentioned. As far as enhancement of disclosure requirements for significant crypto holdings, basically presenting a tabular form that just does a roll forward each year, showing beginning balances, additions, disposals, and then showing that unrealized gain and or loss piece. As far as what's next, there is the anticipation by the FASB that the accounting standard update or ASU should be by the end of this year. We've not yet seen it as of today, so they've got 45 days or so to get that finalized. So there will be a transition period. As far as effective date, that's not yet been determined. So one of those things that as it's finalized or as we get more information, we will share that with our clients. Moving on to the ESG side of things. So environment, social, or governance, or ESG. So with the general focus on transparency, communicating your impact on environmental sustainability, social responsibility, and governance practices. Like I mentioned, this is not quite as far along from a standard standpoint. And so a lot of times on the ESG side, you can kind of look at what public companies are doing and kind of see what's going to be coming down in future years. So as far as just kind of what we're talking about, what might be some items in the ESG veins, if you will, and then some goals or initiatives as far as it relates to higher level items. So on the environment side of things, energy, water, waste, climate, biodiversity, or nature. So a goal might be, access to clean water and sanitation, or affordable and clean energy, some of the zero emission type standards that are or goals for organizations. On the social side of things, health and safety, diversity, equity, and inclusion, talent, brand and reputation, or privacy and security. So from a couple goals there would be, decent work opportunities and possibilities for growth, good health and well-being for stakeholders or individuals served in your communities. From a governance standpoint, ethics and conduct, anti-corruption, executive compensation, board composition, as well as risk management. And so, through the nonprofit lens, thinking from a governance standpoint, how does your board composition align with diversity, equity, inclusion goals of your organization? All right, as far as opportunities go, we've got a couple surveys that we pulled. One is the KPMG survey, and this would be of public companies, but like I mentioned, a lot of that kind of trickles down to nonprofits. So, not great news, but basically 75% of public companies are not yet ready for some of the pending assurance requirements for public companies. Pulling in from a BDO side of things for nonprofits, only about 16, so about 85% are just kind of getting started right now on their ESG journey. So lots of opportunities for awareness and improvement. So, there's a little bit that we hit on for reporting requirements to the IRS, but also for third-party evaluators when you're thinking of potential donors and stakeholders. through publicly available resources such as Charity Navigator, GuideStar, and Candid. As far as what's next or what should I be doing, there's a lot of resources available. Like I mentioned, the ASCPA has some really good resources available. What we've done for a couple of our employees just to try to stay on top of things is making sure from an accounting and kind of what's next standpoint, we've had a few individuals pursue certifications available from the ASCPA from an ESG standpoint. And so as far as what's ahead for nonprofits, continue to monitor kind of what's publicly available, from the SEC or PCAOB standards, including the international standards. But thinking from your organization's perspective, work on defining ESG goals for your organization for impact, reporting, and leveraging. And also thinking from a mission standpoint, there may be potential to expand or shift your mission to meet the needs of stakeholders and other expectations. So quick summary, ESG and crypto assets. With that, I'll transition it over to Sarah, who's going to give us another update.
Perfect. Thank you so much, Kyle. I appreciate it, and I am excited to talk a little bit in line with that about goal setting and how finance actually can drive strategy. So I think that aligns exactly with the direction that you were going. So often finance is thought of as we're the structure, we're the compliance end of the organization. We're about the rules, not necessarily the strategic side of things. But because we have so much responsibility for structure in the future, we're also in a great position to drive change and to be helpful in the accountability conversation. We're going to look at 5 big picture areas that we can have to have the most impact on strategy and goal settings within our organizations. So first thing that we need to look at is risk management. So it doesn't seem strategic to say that it's risk management. We're falling back into the compliance side, the what the rule followers, the things that people think of finance, but it's critical. Oh, we have another CPE poll for those that need continuing education. Make sure to fill that out. But in order to have any strategic plans developed and come to fruition, we have to make sure we've got appropriate risk management systems in place so that we can embark on those plans. In order to drive strategy, we must mitigate our risks or we won't be able to have the strategy. We really need to make sure that we focus on internal controls, making sure that all of the strategic plans that we've got for our organization can come to fruition because we have controls in there. Oftentimes we think about new opportunities or new grants that are available or new programs that we have that we want to embark on as an organization. And we need to make sure that as all of those things happen, controls are in place to make sure the funds of the organization and of the nonprofit of your members or stakeholders are utilized appropriately. Insurance management is another thing. When we think about risk, we need to make sure that we have the foundation set so that we have the appropriate insurance policies in place for all of our different programs, for all of our stakeholders, for all of our board members. Compliance risks, again, these are just big picture, but clearly we need to make sure that we have reported to the IRS, as we talked about earlier, that we don't have any issues there, that if we are required to have an audit or if there's a reason that we feel we do need to have an audit, all of those pieces are in place so that we can set our organization up for success and get that infrastructure built. The last thing I've got on here when we talk about risk management is really making sure that you look at cybersecurity risks. If you're an organization out there, clearly this doesn't all fall under the finance department, but to think that finance doesn't have its hands in all of these things at some way or some point in the transaction cycle is crazy. We all have a lot to do and a lot of things that a lot of things that we're working with, and that includes cybersecurity risk, insurance policies, internal controls, and compliance. So within the cybersecurity risk, it's important to not only evaluate internally, but consider having some partner come in and help you evaluate those risks. Those are changing daily. And I will be the first to say that, you know, my role in most of my clients' lives is to help them make good decisions and help them think about things. It isn't to say I know all of the risks that we have specifically for cybersecurity. It's changing all the time. We have to bring in the right partner. So again, with risk management, the reason it's important for strategy is because we have to support the infrastructure to be sustainable and strategic in order to drive that change. The next thing that we need to look at is reserves, or some people call it the rainy day fund. Some people just look at cash flow. Cash is king. We need to make sure that we've got the right things in place to be able to execute and to be able to drive strategy. So often I've seen nonprofits handcuffs into a situation, or they can't take advantage of an opportunity, partially because they've operated as a no profit, not a nonprofit. You all are nonprofit organizations, which means that you are in it for a mission. You have a mission. You're going to have impact on the greater good, the greater community, or your membership, whatever that might be. So we need to make sure as a finance department that we're looking at our operating reserves, that we have standards that we set in place and we compare to our peers. There's all sorts of trend information out there that we can show our leadership and show our boards why we need to have operating reserves, number one, but then also consider designated funds for strategic purposes. That's why I put on the slide rainy day fund. It can also be strategic initiative funds. Our job as a finance department is education and guidance to the leadership and the board to help build operating reserves, as well as getting those other designated reserves so the organization can move forward with the initiatives they want in the strategic plan. The next thing that I will chat about is just measuring impact. So anytime there's something about measuring, clearly finance is going to be involved in that conversation. So we have our organizations ready for strategic change. We've got the risks managed or mitigated, at least. We've got that structure there. We have the reserves. So now we get to talk about strategic initiatives. Now we need to look at the why and the impact of each of our programs as a whole. I love this metrics. It allows us to really look at what we're doing, why we're doing it, and what it does. This is actually based on a great book, The Sustainability Mindset by Steve Zimmerman and Jean Bell. It's got an abundance of resources in this area. The website is nonprofitsustainability.org. And again, it has a lot of resources just at the website also. But the matrix map helps you to look at how your programs are creating impact and how they're profitable. The key things that we have to consider when we're looking at this map is just clearly we want to make sure that it's all inclusive. List out all of your programs, all of your initiatives, all the things that you're doing as an organization, and then understand where it falls in the metrics. This is a great conversation for your program folks and your finance folks to look at together. I see so often there's just a disconnect in what people define as a great program. Is great impactful or is great profitable? Clearly, we want to make sure when we're filling this out, anything in that lower left-hand quadrant, we're going to stop. It's not impactful. It doesn't align with our mission, and or it just isn't profitable. So those are the areas that we really need to question and say, why are we even doing this at all? It also, this matrix also allows us to really look and prioritize the different programs and the initiatives that we have. Sometimes we can shift priorities. If we have a year where we really need to focus, we need to build those reserves, maybe we need to focus on the initiatives that have that higher profitability to the right side of the spectrum. And always, we are looking at trying to move more of our programs into that upper right-hand quadrant. Clearly, they're not always going to be there. They're not all going to be there at any point in time, but that's definitely the direction we want to make sure that we are helping our teams and our leadership consider. The next thing that we've got is key performance indicators and metrics. So we've got a sound foundation. We've got clear understanding of our program impact and profitability. Now we need to report and make sure that we have the appropriate metrics in place for reporting the progress, the impact, and the success. There's so many different areas that you can have for key performance indicators, OKRs, sometimes they're called, operating results, things that you're measuring on a regular basis. The critical thing to remember is that we have to have something to monitor progress, something that's measurable, something that's data-driven, something that's important to our strategic plan and initiatives. Most of these things that we're talking about, not all, but most, start or have some sort of data from finance. Because we're the backbone of the organization, we can push out many of these metrics to our organization and help all of the different departments, all of the directors drive accountability and movement forward to the strategic plan. So we talked about budget guidelines earlier today. To truly support strategic plans, the budgeting process broadens even more. Every new initiative proposed or grant opportunity has to be scrutinized in that matrix and make sure that we're getting into it for the right reason. Making sure that we're not just thinking about getting the money in the door, but also we're working to make sure it's got the right impact and we have the right mix of programs within our organization as a whole. The budget broadens to strategic budgeting. Align the budget format with grants and functional areas, but also with future initiatives and investments. We have to make sure that the board and the leadership, the department heads are looking at the budget process as more than just it's last year and what's going to change. It's last year, what's going to change, and how is it going to get us to our strategy 5-10 years down the road. The budget should have accountability. It can help to drive some of the metrics that we chatted about on the last slide. Really, the specific priorities and goals over multiple years is what we need to focus on. So we're engaging everyone. We're planning what our strategy is going to be. We're assessing, we talked about with the matrix, where we're at and what we have, what reserves we already have. And then we look at the budget before we can do the reporting. So we're aligning it. We're figuring out a reporting and metrics and targets. And then one key is it has to be more than 1 year. If you are driving strategic change or have major initiatives, 1 year won't allow for adequate planning, and it certainly won't allow any potential naysayers or people, donors, investors. It won't allow them to see new alliances and that you really have thought through the whole process. So we went over finance's critical role in setting and driving the organizations to its strategic vision by focusing on risk management, reserves, impact, metrics, and then strategic budgeting. Next up is Anna Lowe to review public support and what it means and why it's important. So thank you.
Good morning. My name is Anna Lowe, and I work in our tax department, and I'm going to be speaking on public support tests for nonprofits, as well as why they are so important for nonprofits to meet. Here is a brief overview of the primary topics I'm going to touch on today. So we are going to touch on the different tests, what options are out there if you are concerned you may not meet criteria for public support, and what happens if you don't. So 501c3 organizations need to complete Schedule A as part of their 990 return each year to show support that they are a public charity. So there are 12 different reasons for public charity status that can be selected. And today we're going to touch on the 2 public support tests for public charities. So one is for organizations described in sections 509A1 and 170B1A6 of the Internal Revenue Code, and one for organizations described in section 509A2. For both public tests, public support is measured using a 5-year computation period that is going to include the current and 4 prior tax years. So generally, the 509A1 test requires that the organization receive at least 1/3 of its support from contributions from the general public or meet the 10% facts and circumstances test. So we will touch on the 10% facts and circumstances test as a separate slide. But for the 1/3 rule, the 33 and 1/3 or more total support must come from governmental agencies, contributions from the general public, and contributions or grants from other public charities. So for organizations who elect to use this public support test, it is important to monitor excess contributors in each year, which would be reported on page 2, line 5 of Schedule A. In calculating excess contributions, you'll need to evaluate the portion of total contributions by each person or organization other than a governmental unit or publicly supported organization included on line 1 that exceeds 2% of the amount shown on line 11, column F, which is the sum of the total support for the 5-year period being measured. The contributions reported on this line are going to be backed out of the gifts, grants, contributions, and membership fees that are reported on line 1. This lowers the amount of public support revenue and therein decreases the calculated public support percentage. So it is important to make sure that your organization's contribution revenue is not primarily coming from a single source. So if your organization receives more than 10%, but less than 33 1/3% of its support from the general public, other public charities, or a governmental unit, it can qualify as a public charity if it can establish that under the facts and circumstances, it normally receives a substantial part of support from these sources. So what are the facts and circumstances mentioned defined as? Luckily, the regs give us a little bit of direction. So they give us 4 main areas used to evaluate whether an organization is publicly supported. An organization is not required to satisfy all of the factors. In fact, the factors relevant to each case and the weight accorded to any one of them may differ depending on the nature and purpose of the organization and the length of time it has been in existence for. For this reason, organizations are encouraged to give detail on why they do satisfy to justify why they are publicly supported. So the first thing they're going to look at is the percentage of financial support. The closer the public support percentage is to the 33 1/3 threshold, the less scrutiny that is going to be put on determining whether you are publicly supported. The IRS is also going to look at the organization's sources of support. So receiving support from a variety of persons or organizations rather than receiving all or most of the support from members of a single family or entity is going to be more indicative of being publicly supported. Another factor that will be considered is the composition of the governing body. So the fact that an organization has a governing body which represents the broad interests of the public rather than the personal or private interests of a limited number of donors will be considered in determining whether an organization is publicly supported. And the fourth and final factor is going to be the availability of public facilities or services or public participation in programs or policies. So whether an organization is of the type which generally provides facilities or services directly for the benefit of the general public on a continuing basis will be considered evidence that such organization is publicly supported. For sake of time, I'm not going to go too deep on these, but it is a great option to keep in mind for organizations that may have years where the contributions just don't come in as expected and you don't want to lose your public charity status or have to switch public support tests. So the 509A2 test requires that organizations receive more than 1/3 of its support from contributions from the general public and/or gross receipts from activities related to its tax-exempt purpose. This revenue specifically includes gifts, grants, contributions, membership fees, gross receipts from admissions, sales of merchandise, performance of services, or furnishing of facilities in an activity which isn't an unrelated trade or business. And the second piece of this test is that an organization can receive no more than 1/3 of its support from gross investment income and unrelated business taxable income. Under this test, it is important to monitor whether any of your contributors are going to be disqualified persons, as revenue received from these individuals would be reported on page 3, line 7A of Schedule A. For evaluating this, you'll be looking at all of the sources of revenue that are included on lines 1, 2, and 3 of Schedule A, page 3. And the revenue reported on this line will be backed out of the total public support revenue and therein decrease the calculated public support percentage. So you want to ensure that your organization's revenue is not primarily coming from any disqualified persons. And there are a couple ways to fall into being treated as a disqualified person, but the first one I'm going to touch on is going to be the most important and commonly missed, and that is being a substantial contributor. So a substantial contributor is going to be any person who gave more than $5,000 if that amount is more than 2% of the total contributions that the organization has received from its inception through the current year. In case I didn't emphasize that piece enough, in looking at substantial contributors, you're looking at the organization's total contributions since inception. This is why it's so commonly missed and not filled out when it should be, because many older organizations may not have good records of their contributions going back to inception, or if the organization originally fell under the section 509A1 test and switched to the 509A2 test, they may not have known that they would eventually need these records of contributions to be kept. And it looks like another CPE poll just popped up, so I'll give you a second. But a tricky part with substantial contributors is that once an individual qualifies as a substantial contributor, they are going to remain a substantial contributor for all future periods, even if later contributions by others push that original person's contributions below the 2% figure. And that also included as disqualified persons are going to be foundation managers, owners of more than 20% of the voting power of a corporation, profit interest of a partnership, or beneficial interest of a trust or unincorporated enterprise that is a substantial contributor of the organization, as well as any family members of an individual in the first three categories. And finally, a corporation, partnership, trust, or estate in which persons described in the first four categories above own more than 35% of the voting power, profit interest, or beneficial interest are also going to be disqualified persons. One helpful caveat is that other 501c3 charities are not going to be disqualified persons, so those do not need to be monitored and tracked. If an organization doesn't qualify as a publicly supported organization under Section 509A1, it can complete Part 3 to determine if it qualifies as a publicly supported organization under Section 509A2 and vice versa. So if one organization no longer meets one of the tests, you do have the option to switch tests if you meet the other one. One thing to note, however, is that the IRS doesn't update its records on an organization's public charity status based on a change the organization makes on Schedule A. Thus, an organization that checks a public charity status different from the reason it stated in its exemption letter or subsequent determination letter, although not required, may want to submit a request to the IRS Exempt Organizations Determination Office for a determination letter confirming that it qualifies for the new public charity status if the organization wants the IRS records to reflect that new public charity status. So that'll be a Form 8940 request for miscellaneous determination, and that comes with a $500 user fee that must be submitted with the request. So if the organization doesn't qualify as a publicly supported organization under Section 170B1A6 or Section 509A2, it is now a private foundation as of the beginning of the 2022 tax year for filing purposes and shouldn't be filing that Form 990 series return or Schedule A for the 2022 tax year. Instead, the organization would need to file a Form 990 PF and check the initial return of a form of public charity on Form 990 PF. So next we are going to be hearing from Bethany, who's going to speak on process automation.
Awesome. Thank you so much, Anna. All right. Well, my name is Bethany Verbal. I am a senior manager in Maner's Consulting Division, and I am the wrap-up person for our 9 and 90 today. So I hope everyone is really excited. I know I am, to talk about process automation, what that looks like, and really why it's so important. So we've seen an explosion, that's the term I'm going to use, over the past few years in interest in automation. But it can be really hard to understand. It can kind of be intimidating, right? In a lot of cases, I hear nonprofits say, well, automation is for manufacturing companies, right? It's the robotic arms. It's, how do we get these things to these places? It's not something I can use. But with the way that the world is changing, the conversations around artificial intelligence, AI, and constant changes in the employment landscape, at this point, nonprofits can't afford not to consider process automation. So we're going to talk about why automation is so important for nonprofits, talk about some of the initial steps that go into it. So why do we automate? It's a big change. It takes work. Where's the value? So the first and really the biggest is in maximizing the resources that we have. I don't know of a single organization, much less a nonprofit, that feels like they have adequate resources. That could be hours in the day, it could be staffing, it could be funding. We can always use more. Process automation lets us internally outsource things that aren't the highest and best use of our time. So that could be things like staff member, hand keying in accounts payable invoices. It could be we ask our executive director to hand sign each individual check. Those aren't value add tasks. I would much rather see our finance staff looking at projections and budgets. and our executive director can focus on, fundraising, speaking with legislators, really fulfilling our mission. So when we talk about why we want to look at process automation, we're talking about that age-old proverbial, how do we do more with less? How do we maximize what we have? Process automation also allows us to look at scalability. For many nonprofits, the pandemic brought them into the spotlight, and it really highlighted how greatly our community relies on nonprofits, which means that we've seen significant growth in nonprofits over the past few years, and that's not going to change. So if we're struggling to keep up with demand, we're struggling to provide our mission, to really fulfill our mission, there's no room for growth, and we know that that's going to happen. So by automating processes, we give ourselves that space to grow. The other two elements of why we really want to think about process automation are accuracy and timeliness. We know what these are, and I think we can all agree they're pretty important, right? But how is automation going to help me with that? So when we consider accuracy, how many times have we looked back at a journal entry and maybe realized that we flipped our debits and credits? So we have to go in, we have to do a reversal, we have to make the correct journal entry. We should probably have our journal entry reviewed. There's a lot of steps that come with that, all because something was inaccurate. Or how many times have we taken one last look at the financials before our board meeting and realized that maybe we pulled in the wrong budget? How many times have we pulled 7 different spreadsheets from one system and we've copied and pasted into one Excel, and then we've made pivot tables, and then we've hand entered some things into our accounting software, all to get to one number? So when we're doing that, we're hoping that we copied and pasted correctly. We're hoping that maybe we didn't run one parameter wrong on a report, but it's a strategy of hope, and that's not our best strategy, right? So process automation removes a lot of that human error element and allows us to focus on analysis instead of data entry and double checking. And finally, timeliness. I say finally, truthfully, we probably could have had this whole 90-minute conversation just on why we should automate processes, but then we would have missed everything else that my teammates shared, and I don't want to do that. So we're sticking to 4 reasons. So data is only valuable if it's timely. If we're getting financial statements 3 months after month end, then we're looking at historical data that probably has changed. Our staff only have so many hours in the day. Machines and software, they exist solely to assist us and do the job that we've given them. So when we automate processes, we're giving ourselves a chance to look to at-the-minute data to inform our decisions. How amazing would it be to look at a dashboard every single day that helps us see our cash flow, our alignment to budget, maybe our donor numbers, and know that that data, it's not 3 months old. It's not last year's data. It's to-the-minute data. That's what process automation does to us. So it truly can be revolutionary. So hopefully everyone's like pretty fired up to automate some processes now. So I want to talk about kind of what that would look like and maybe some of the beginning steps. So this is sort of the continuum of steps for any business transformation, but especially in process automation. First step is to align to our strategy and goals. What's our strategy? Where do we want to be? How can we make sure that the initiatives that we're taking align to that? Then architect changes. So this is when we start looking at, we'll talk to our team members. We'll see what their processes are. Then we're going to develop initiatives. We know what our processes are currently. When we come back to our strategy and goals, what initiatives do we need to create to align to those strategy and goals? Then comes the scary part, but also the exciting part too. It's implementing those changes. We've done all this work in the first 3 phases. Let's do it. Let's implement it. And then we measure success. It's not enough to just do it. We have to measure it. Was it successful? Where isn't it successful? And just because one element isn't successful doesn't mean we throw out the whole process. It means that we get to phase 6, which is continuously improve. So when we're measuring success, we're not saying this failed, the whole process failed. We're saying this failed, let's improve this, because then we're in that method of continuous improvement. So if you want to get started on process automation, this is really my bread and butter. This is, I really focus on process efficiency, process automation at Maner. So the first step is discovery. This is always how we start. Tell me what you do. Tell me how you do it. Can you tell me why you do it? Are you making 17 Excel spreadsheets and none of the cells are protected? I love Excel. I'm an accountant. We have to love it. But it's not always the best method. So, doing the discovery on our current processes and teams. Then we do a technology assessment. What technology are we actually using? We know it's approved. Maybe it's QuickBooks Online, Office 365, but what else are staff using? I mentioned AI earlier. Are our staff using ChatGPT? That isn't necessarily a bad thing. We can't exist in this vacuum where we pretend AI doesn't exist. We're going to be 20 years behind everyone else if we do that. But we have to know what our people are using and make sure that we have our arms around what that looks like. And then once we know processes, we know elements that are being used, this is the fun part. It's the recommendations. It's the important return on investment. So if we start AP automation, so instead of hand entering where invoices get scanned, they're automatically in a software, they're automatically coded. We know there's a cost associated, but maybe it saves our staff 10 hours a week. Imagine what you could do with 10 additional hours a week. Or maybe a longtime staff member in our organization is retiring, and we find out that through process automation, through using a budgeting software, that we don't actually need to hire a full-time person. We can automate half that role and outsource the other. So process automation, when we really look at it comprehensively, can be revolutionary to our organization. And it's not just for manufacturing. It's not just for big organizations. It is for nonprofits of any size and shape. So those are my 10 minutes. I hope everyone is very, very excited about process automation. And I will kick it back to Brandy to lead us out.
Thank you, Bethany. That was awesome. And I want to thank all of our speakers today for coming on and giving us this information. I hope everybody can take a little bit of tidbit of information away today and help you in your everyday work life. And I want to thank everybody for attending. We will on Monday be sending out a recording of this presentation along with the slide deck. So look for that in your email come Monday. And our contact information will also be in that email. If you have any further questions about anything we talked about today, please feel free to reach out to us. And I hope everybody has a great holiday. Thank you.